good. Only 4.6 of the population is unemployed. Right? So next, external balance implying no longer term tendency for balance of payments or current account deficits. Minimized current account deficit, which is imports and exports balanced in the proper manner. Right? Fourth factor, economic growth as measured by the annual rise in GDP. We will talk about GDP. Actually, what do you mean by GDP? Yes. Yeah, that I know for a fact. Gross domestic product. I can help with that. GDP is gross domestic product. I'm asking what is gross domestic product? Yes. Anyone? Yeah? Yeah. So GDP is one main economic indicator where we can say about one country's economic performance. The other part is GNP, not UNP, GNP. Gross national product. What's the difference in between? Don't know. Gross domestic product, domestic, right? Gross domestic product is everything, the total of everything, goods and services produced within the borders of the country. Clear? Within the borders of the country, everything produced comes under gross domestic product. Total of everything. Right? What is gross national product? Our burgers go to every country. Right? Sri Lankans found everywhere. You name Alaska, you name Greenland, you name whatever the country, Sri Lankans are there. We are that proud nation. Everything produced by the people, all Sri Lankans all over the world, is coming under GNP. So that is not within the borders of the country. Right? Some people will go to Australia, Canada, or somewhere else and will produce goods and services and will bring back the revenue to the country. So that is also included in GNP. So which one is bigger? GNP or GDP? GNP. Right? Gross domestic product and gross national product. Okay. So whatever the stuff produced inside the borders by the foreigners coming under GDP. Right? Then, in effect, the bigger the diamond is, better the performance. Important. Bigger the diamond is, better the performance of the economy, and the more successful economic policy might be judged. Of course, the conduct of economic policy by any government in a market economy is constrained by many factors, most of which are outside of control of the government. So, we'll see the economic diamond first. So, see. This is the economic diamond. Does it look like a diamond to you? No? Imagine it. This is like a diamond, right? Don't ask questions. This is like a diamond. So, economic diamond, what are the four factors? Inflation, current account balance, unemployment, economic growth. So, what do they say? Bigger the diamond is, better. Understood? So, you can draw this for a country. So, once you are like literally there, you just search economic diamond for UK, economic diamond for whatever the country, right? Economic diamond for Namibia, Bermuda, any country. So you can say, getting bigger and bigger will give you the better performance, right? Next, what they said, that. So next part is question number 1 and 2 both. Read question number 1 and 2 and take the answer quickly from whatever the stuff we discussed so far. Question number 1 and 2 both. Two both. Which of the following is not an objective of macroeconomic policy? Not an objective. Yes, that's correct, Tarini, but inside the borders, right? Country citizens, yes. GNP is from country citizens, even it is with apart from the borders, that's okay. GDP is within the borders only. So whatever the country's citizens produce, even above beyond the country's borders, that is GNP. Question number 1, what is the answer? Which of the following is not an objective of macroeconomy? Economic growth? Agreed. Control of inflation? Lower levels of taxation? Yes. Balance of payments. What's the answer? Those who say A, B, C. Yes. So this is macroeconomic policy is all about the government, right? Right. So taxation is again government revenue. So government will not want lower levels. They will need higher levels of taxation. So they can earn more revenue. Next part. Question number 2. You have 4 sentences. Just tell me whether that is true or false. Quickly select. First sentence, economic growth always brings benefits to all members of a society. True or false? Those who say true, those who say false, right? That is economic growth always, they say always, to all the members. Always, all the members, that might not happen sometimes, right? Sometimes the economic growth might bring disadvantages to people. Imagine there is a person who is living with the interest earned through a fixed deposit, right? A senior person, retired, whatever the earnings he has put that in a fixed deposit, getting the interest income and living through that. Economic growth do happen. Economic growth do happen. So inflation levels rise, lot of sophisticated goods and services to purchase, and the price levels drastically has increased. Is he benefited? Is he benefited? Not all the members of all the society, right? Go to the second sentence. Economic growth can lead to an increase in imports. What do you think? Those who say true? Those who say false? True. Because why? We are coming up with this concept globalization day by day. and it's coming into global family now. Global, it has coming to, with time it came, initially it was globalization. Then the concept of global village. Now it's global family, which is we can't stay as an isolated country, although North Korea do, right? Countries like North Korea do, but no, nothing. We can't be like that. We need to deal with the international context, and we need to now, when the economics growing, production definitely grows. When production grows, you might need raw materials which are not available in the particular country. So definitely you will have to go to imports. So that is true. First one is false. True. Third one, inflation does not affect those on fixed incomes as much as those in employment. True or false? Inflation does not affect those on fixed incomes, just like the person I mentioned, rather than the person in the employment. True or false? Nothing to think. False. So if somebody is having the same amount income and the price of goods increases, isn't that affecting? Yes. Inflation encourages investment in a national economy. What do you think? Inflation encourages investment in a national economy. But inflation, national economy, and inflation. Yes. Those who say true, those who say false. What does it say? Yes. They have given false. Why does it happen? When the inflation levels increase, inflation encourages investment in a national economy. Why do I say that is? Imagine there is a construction project being negotiated with Japan or something, right? As a country level project. If the inflation is rising and rising, what will happen to the price of raw materials? Construction material to bring the construction. So if the inflation rates are rising, will that encourage investment? Will that encourage? Do I need to write any sort of definitions or explanation? Do we have to write? Do you want? You better write down. Huh? So this is false, this is false. If you need clarifications, I can give. If not, you can write. Okay. So for first one, A, answer is false. You may put a star mark and write down simple definition. Economic growth is often very unevenly spread across the population. You can write it. Economic growth is often very unevenly spread across the population. You can think of that. So B, it's true. Economic growth can lead to increase in imports, it's true. Consumers choose to spend their income on foreign rather than domestically produced goods. For the second one, right? Right? So when economic growth does happen, demand will definitely increase and consumers might want foreign or imported items, and the sudden increase in demand cannot be matched to the supply within the country itself. So the rise of imports will happen, right? That you can like simplify and write. Third sentence, is again false. That I does not want to explain. Fixed income, that does not want. So last one. High inflation levels make forecasting the results of the investment projects more difficult. High inflation levels make forecasting the results of investment projects more difficult. Right? Okay. Higher levels of taxation, if they say. Question number 1. No, even at that point, that is incorrect, Danika. Right? It's not a basic objective, right? So taxation, raising the levels of taxation or lowering the levels of taxation is anyway not a basic objective of a macroeconomic policy. So under fiscal policy, we'll be learning about the taxation, but still having higher levels of taxation, that cannot be interpreted as a basic objective of a economic policy. Right? All right, so the next part is quite interesting, the circular flow of model, which I'll be starting on next week, right? So you can have your break and come. After that, I'll be discussing about the mock exam and the questions which is remaining in financial systems too, right? We shall complete that and finish. Okay, that and also the 30 questions from the mock exam. Next is so interesting and important, the circular flow of cash inside an economy. How does it happen? We shall discuss it next week. It's an interesting part. Right, you can have your break. It's 2:17. You can come back in 20 minutes, which is 2:37. Right? Why feeling bored? You didn't have a class today morning, no? Good people. You came straight to our class. Okay, have your break and come, guys. You said nothing. You said that. You said nothing. You said of questions, but Right, we'll start, guys. We'll start with this mock exam. Right. Okay, question number one. We'll quickly do it, right? So these questions are not that difficult. It's so easy. So I don't want to like spend like 2 hours explaining all this, right? Agency problem refers to which of the following situations? What was agency problem, guys? Agency theory. We learned it under stakeholder management, is it? So agency problem refers to, what was agency problem? Anybody? Yes. Under stakeholder management, we understood that agency problem is one of the most common issues. There were two parties, principal and the agent, right? Principal was somebody who is coming and investing shares in the business, and agents, the directors who is being appointed by the shareholders to manage this, right? So they were having like different kinds of interests with in terms of the business. So question number one, they need agency problem refers to which of the following situations? Shareholders acting in their own short-term interests rather than in the long-term interests of the company. A vocal minority of shareholders expecting the directors to act as their agents and pay substantial dividends. Companies reliant upon substantial government contracts. The directors acting in their own interest rather than the shareholders' interests. I think the answer would be D. Right? Answer is D. So was this document uploaded to you in the LMS? Yes? Answer sheet and the question both. Okay. Question number two, which one of the following would result from setting of a maximum price for a product that is above the equilibrium price? What was equilibrium price? Equilibrium price. Come on. Yes. Equilibrium price. Where the demand and supply was equal. So the graph was like this, you remember, and then maximum price was set above it. Maximum price of a product that is above the equilibrium price. So what can you say about that? Right, if I drew whiteboard, I drew. You cannot see the share screen. Those who are joining online, can't you see the screen? Please confirm. Can't you see the document, guys? This. Can see. Okay. So if I draw, so this was the equilibrium, right? Why I can use it? You feel awkward when I'm using it. Okay. Yeah, like. Okay. So this is equilibrium, right? This is equilibrium. Maximum price set above the equilibrium. What about it? So that's what they ask. So this is what curve? This is right. So in that sense, they are asking which one of the following would result from the setting of maximum price. Supply would outstrip demand. Demand would outstrip supply. The demand curve would shift to the left. No effect. What's the answer? What's the answer? Which one of the following would result from setting a maximum price for a product that is above the equilibrium? What does they say? Read. Can you see? As the new price is maximum above the current equilibrium, there would be no effect. If it had been set below the equilibrium, then the demand would outstrip supply. Why do you say so? You could have easily said, right? You could have easily said, here the demand is less and the supply is high. You could have said that. Why does the answer say it's no effect? Answer say it's no effect. Why? If you go back to your tudes and see, whatever the line we drew above the equilibrium was not maximum price. That was minimum price. But this is saying maximum price is being set, right? Maximum price is being set above the equilibrium. That's why the answer is D. Clear? So maximum price is set above the equilibrium price in a situation where supply is high and the demand is less. So what will happen? That will create no. If that was the minimum price, then of course it's. Understood? You better go and check your tubes. Whatever the line we drew above the equilibrium was minimum. Okay. Question number 3. Enjoyable. I mean the name. Currently sells 10,000 units of its children's outdoor activity sets. That's a children's outdoor activity set, guys. Don't laugh, right? Per month at $10 per unit, and the demand for it, so it's a matter of calculating what? Price elasticity of minus 2.5 or rise in the price of product to 11 will do which of the following? What's the equation for calculating price elasticity of demand? Yes. Price elasticity of demand. You can't remember? Percentage change in quantity demanded divided by percentage change in price. So you can put that here. They say currently sells 10,000 units of children's outdoor activity sets per month, $10, 10,000 units. And then the demand of the product has a price elasticity of 2.5, rise in the price to 11. You can calculate the number of units first, right? Using the price elasticity of demand. Now here the price elasticity of demand is given. Percentage change in price you can calculate because 10 being changed into 11. You can calculate the percentage change in output, right? Then you can multiply that by the price which you are selling it, which is at 11. Take the revenue impact. So I'll give the answer. This with the PD of minus 2.5, the quantity demanded will proportionately change 2.5 times as much as the price when the price is changed. 10 to 11, 10% change. Keeping that at 25, so 7,500 units you can get. Older revenue is 10,000 units being sold at $10. Older revenue is this. New revenue is 7,500 units sold at 17,500. So the net change is this. Okay. Easy, right? Just a matter of putting the numbers here and there. Question number 4. If an indirect tax is imposed on a good or service, indirect tax is imposed on a good or service, which of the following will result? Which one? Now also read and tell. Question now also read and tell. So apparently you are doing it twice. Indirect tax is imposed on a goods or service. Remember what indirect tax was? Just like VAT, sales tax. Right. On a good or service, which of the following? The price will rise by the amount equal to the tax. The producer decides on how much of the tax to pass on to the customer. The price rise will be smaller. The greater is the price elasticity of demand. Price rise will be greater. What's the answer you suggest? See. You guys? See. Let's see. Initially the same price. Now they are talking about the impact of indirect tax, right? Initially, for the same price, the producer will receive a lower income as some of the sales levy is now passed on to the tax authorities. How does that happen? Initially, you sell items at this price, but at the latter period, you are selling the same price, right? But whatever you earn, whatever is supposed to come as profits to you, you are sending that to the tax authorities in terms of a tax. Okay. So then, an indirect tax is paid by the consumer, so the producer does not decide how much is passed on to the consumer. Producer may choose to raise the price. Producer may choose to raise it. Producer may choose to raise the price. Right. Producer might change the price in order to sustain the income levels. Smaller price elasticity of supply would mean that the change in the price doesn't affect. Price elasticity. Again, if a price is elastic of a good, when you change the price, what will happen to the demand? Elastic. Small change in price, small or bigger change in demand, bigger change in demand, right? A smaller price elasticity of supply would mean that a change in price doesn't affect the level of supply as much. If an indirect tax is imposed on a good or service, which of the following would result? Price rise will be smaller, the greater is the price elasticity of demand, which is why when an indirect tax is imposed, whatever the tax you have to pay apart from the profits you earn, that has to be transferred to the tax authorities. So with that, if a price rise happens, right? Price rise will be smaller, the greater is the price elasticity of it, right? Simple stuff. Question 5. Calculate the earnings per share. Earnings per share equation. Where did we find earnings per share? In which tube? Yes. Second, measuring returns to shareholders, right? Measuring short-term returns to shareholders, we had two equations, ROCE and EPS. ROCE was about the old return, total return, but this was the return to ordinary shareholders. So how can you calculate earnings per share? Information given. All right. Profits before taxation and interest of 110,000. Interest charges 45,000, tax bill 30,000, preference share dividends 15,000, ordinary dividends 5,000, 125,000 share capital in issue, and the shares each have a nominal value of 0.5. How to calculate the earnings per share? The computation. This. Profit after interest, tax, and preference share dividends, you can calculate all the information given. Number of shares, why do I take it like this? They have 125,000 worth of shares, but they say, but one share is 0.5. So you might miss this point. Remember, nominal value of one share is $0.5. Total value of shares is 125, which is, this is how you get the number of shares issued. Clear? This is the point which you should miss. Everybody got this correct? Remember? No. Right. This is how you calculate this. Next question. Question number 6. A farmer produces 1,000 tons of wheat with the government guaranteeing a $50 per ton produced. If the subsidy is increased by $5 per ton of production and rises to 1,200, price elasticity of supply using non-average arc method. What was non-average arc method? Remember something like that? You learned in your scholarship time? No? Right? What's the equation to calculate price elasticity of supply? Yes, quickly. Price elasticity of supply. Equation. Yes, that's the percentage change. So, elasticity, how can I calculate? Percentage change in quantity supplied divided by percentage change in price. So, using that non-average arc method. So, if you average, you are dividing by the average figure. And if not, that final minus initial divided by initial. So, how can you take the answer? The given question number 6. See, percentage change in quantity supplied, percentage change in price. Okay. So, this stuff you should get it correct. Question number 7. Question number 7. Easy question, right? I think we did the same one question in the class. Didn't we? Right. In the diagram, what action will suppliers take at the price of P high? P high is here. What will they do? In this position, what has happened? What's the equilibrium price here? Guys, I'm talking to the students. I can see here in the class. So you can respond. What's the equilibrium price? What's the equilibrium price? P1. So in P high is here. What has happened to the demand and supply? Which one is high? In P high, Which one is high? Demand or supply? Supply is higher. Demand is lower. Right? Demand is lower. Supply is higher. So what can you do to come into the equilibrium? To arrive at the equilibrium, what can you do? Decrease price. So answer is D. Okay. So when you decrease the price gradually, this will come to the equilibrium. Question number 8. Question number 8. Again, price elasticity of demand. Demand for a product is 40,000 units when the price is set at 60. Price at 60, 40,000. Product has a price elasticity of demand given already, minus 1.2. Sales manager has suggested lowering the demand, lowering the price to stimulate demand, 50,000. Then that's asking what price? Question number 8, easy. It's a matter of putting into the price elasticity of demand equation. Right? So price elasticity of demand is equal to percentage change in demand divided by percentage change in price. Percentage change in demand, you expect 40,000 to go into 50,000. So change is plus 25. PED you already know. So percentage change in price which should happen is minus 20.83. You can calculate. To achieve an increase of demand of 25, price should be lowered by 20.83%. 60 is the initial price. So the new price is 20.83. When it's reduced by 20.83%, new price is 47.50. Right? Nothing to explain these things. So, yeah. But we have taken it to 47.5, so it should be 48, if it is so. Oh. Is that the case? The free marks for that as well. So I think you might get 120, 125% like that, no? If I give free marks. Now anyway, you are given free marks, no? Same on 15 questions, no, you had? Right, okay, free marks for this then, no? So be mindful about that. That's a good point, right? If they ask is for deal $1, closest dollar, just mention 48, right? Right, accepted. Then, question number 9. The introduction of a national minimum wage will lead the business to reduce its number of employees most when which of the following is the case? Only 3 marks given to you. Who else needs? Okay. Right. Okay. So whatever the mark you have got, you can have some additional 1 mark, right? Okay. Accept. Introduction of a national minimum wage. Minimum wage, do you remember? Introduction of a national minimum wage will lead a business to reduce its number of employees. Will lead to reduce its number of employees most when which of the following is the case? The demand for its final product is price elastic. Wage costs are a small proportion of total costs. There is a low degree of substitutability between capital and labor. The supply of substitute factors of production is price inelastic. What do you suggest? They are asking, when you set a minimum wage, the employees reduce its number of employees. Why? A business have to reduce its employees anyhow due to several reasons, like if the cost of labor is really high, one month. If the profit margins you earn is really less. So if these kind of things do happen, the company will have to do nothing, but they will have to lay off some employees. That is happening because of what? I feel the demand, if the final product is price elastic, right? Which is when you make a small change in the price, the demand changes drastically. So that whatever the profits you earn might go down, and as a result, you will have to lay off some labor. So anybody agreed with A? Yeah, right. So 9A. Question number 10. All of the following are examples where externalities are like to occur except which one? What was externalities, guys? Externalities. What was externalities? Anyone? Positive and negative externalities. What was externality? Simply spoken. Yeah, what's this externality? Can't remember? Yeah. What's an externality? I'm asking. Economies of scale, you remember. Then, right, keep it aside. So select which one? All of the following are examples where externalities are likely to occur, except which one? A business providing training schemes for its employees. Externalities is there. Government expenditure on vaccination programs for infectious diseases. Correct? Attending a concert given by a government-funded orchestra. No? No externalities, right? Simply positive effects, right? Positive effects gave positive externalities, simpler meaning. Negative externalities was something was given by demerit goods, remember? As a whole, we just have to suffer. If somebody here smokes, definitely our health will be affected, everybody's. Inside the class, go out and smoke, that doesn't matter. Question number 11. If a demand curve for good A shifts to the left when the price of good B rises, we may conclude which of the following. Demand curve for good A shifts to the left when the price of good B rises. So if two types of goods are interrelated in terms of price and this thing, that is known as complementary goods or but substitute goods. What kind of a good is this? What will happen? Demand curve moves to the left means demand reduces. Isn't it? Demand curve moving into the left means demand reduces. So price of a good B rises. As a result, demand reduces in good A. So this is complementary good or a substitute. Complementary it seems. Right? So what will happen? What's the answer you suggest? See. We'll see. Right? Yeah, it's C. We saw it C. Right? A shift to the left means a drop in the demand, as I said, in the same price level. Raising the price of a good will be normally lead to a contraction in demand for good B. So then that's a complementary good. Right? Very good if you have understood and identified that. Then, question number 12. X limited is price elasticity of demand. How to calculate? I'm not going to do it, right? Price elasticity of demand, percentage change in quantity demanded divided by percentage change in price. You may insert the figures and calculate, right? Simple. If the reserve asset ratio was 25%, how much money would a bank create from an initial deposit of 100? What's that? All of a sudden, we were in the world of demand and supply and all these things, and all of a sudden, reserve ratio. What was reserve ratio, guys? Do you remember? Yes. Yeah. Credit multiplier, did we speak? Right? So if somebody goes and deposits 100 rupees in the bank, that keeps on multiplying and multiplying several times, and credit can be created. The same amount deposit is utilized for the other people to give money. Understood? So ultimately, how can you calculate reserve ratio? That was 1 divided by credit multiplier. This is how you can take it. Credit multiplier is equal to 1 divided by reserve asset ratio. So as a result, 1 divided by 0.25 is equal to 4. How many times it gets multiplied? 4 times. So if you deposit $100, that will go up to 4. Right? Reserve asset ratio. Credit multiplier is equal to 1 divided by reserve asset ratio. Question number 14. Which one of the following most likely to have a perfectly inelastic demand? Perfectly inelastic means what? Straight vertical line, clear. So what do you mean by that? Right. When you change the price, let the price be any amount, will the demand change? Demand will not change. So tell me that kind of item. Luxury cars, Rolls Royce, no? Fresh fruits. Then life-saving medicine with no substitutes. Could have been if Kahelia was not here. Could have been the answer if Kahelia was not here. Fast food meals. So answer is very simple, right? So no substitutes. So imagine this person is gonna die. We anyway will find out money and bring some medicine and we'll give healthcare. Right? We think so. Right? Question number 15. Calculate the earnings per share. Equation. Earnings per share equation. Yes? Yes. Earnings are available. We can reduce whatever profit or everything divided by number of ordinary shares. Remember. Ordinary shares. So information given, I can show you how to calculate. Right? It's the same one. Oh. This is also the same. Good. If the demand curve for good day shift, so then I don't have to explain it again, no? Entire 15 I have done. Is it? So this question was also there, no? Demand curve for good day shifts to the left when the price of good B rises. Slightly different, right? Which is in the answer sheet, it was complementary good, and they have asked what's the type of good right here. Right. Apologies. Law of demand states that. Did we learn something like that? Law? That's not my subject. Law of demand. They have separate lecture to us. Law of demand. What does law of demand say? Yes? This was in your scholarship even. Law of demand. Yes, quickly. Price increases. Quantity demanded. Thing to say. If the cross price elasticity of demand between two goods is positive, the goods are considered to be. Good question. Cross price elasticity of demand between two goods is positive. What do you think? Substitute. Yes. Complements. Normal goods. Substitutes. Why do you say so? Cross price elasticity of demand means? What is that? What do you mean by cross price elasticity of demand? Did we learn something about it? Is it? Of two goods is positive. You see, have they given any explanation? A positive cross price given. See, positive cross price of elasticity of demand indicates that as the price of one good increases, the demand for the other good also increases. Cross price elasticity, right? So in exchange rates, you might have heard cross exchange rates. Just like that, cross price of elasticity, if that is positive, cross figure, positive means this. A positive cross price elasticity indicates that the price of one good increases, the demand for the other good also increases, which is meaning they are substitutes. Good question, right? Remember this definition, right? Question 19. Right. All of the following are examples of where externalities are likely to occur except one. Same, no? Good. Very good. Same, B. So you could have done this in half an hour, no? Right. Perfect. If the price elasticity of supply for a product is greater than 1, what do you mean by that? Price elasticity of supply is greater than 1. How can I get it? Percentage change in quantity supplied divided by percentage change in price, which is a plus figure, and greater than 1 means percentage change in quantity supplied is higher than the percentage change in price. Accordingly, the answer would be elastic. Clear? Did you understand how do I take it? Right? Percentage change in quantity supplied divided by percentage change in price. Greater than 1 means, imagine it's 2. Let's say it's 2. So it's 2 divided by 1. So when percentage price changes in a smaller manner, double the way quantity supplied changes, which is elastic. Clear? Question 22. Which one of the following same, no? Perfect. So if you incorrectly do the previous one, get it doubled. Right? If an indirect tax, it's the same one thing. Very good. This was also same. Figures different. Calculating price elasticity of supply and average arc method, you know how to do. It's also production of national minimum wage. This one we didn't do, no? Did. Price elasticity of demand, inserting the figures. Okay, reserve asset ratio. Same, good. Primary role of price mechanism in a market economy. Primary role of the price mechanism in a market economy. What do you think? Out of these 4? To ensure equal distribution of wealth, to allocate scarce resources, to fix prices for all goods and services, to regulate government spending. Price mechanism. Yes? A, B, C, D. Yes, to allocate scarce resources. That's the basic economic problem. That's when there is a shortage of a product in the market, what is the likely outcome on its price? Simple. Shortage of a product in the market, price will increase. Right? So that's easy. Question. $24. It's question number 28. What he says is it's a different question. It's not the same thing. Huh? 28. The same on question, but they have given the answer as 300, isn't it? That cannot happen. Do what you know what they have done. Okay, 28, the answer should be 400. Yes. So what are the other problems you have? Yes, 400 it should be with Usha. So other problems? Okay, the same one. Right. Okay. So that's okay, right? So anyway, you have got like some marks, right? So before like doing the mock exam, I wanted you to try it, right? So I didn't expect you to like score 100 out of 100 or whatever to go get low marks or whatever, right? So the learning points is time management, right? So I think it was like, it didn't meet my expectation actually, right? It didn't meet my expectation because like having the same on questions, you can't like think of the time factor. So the same on questions, you might have done it easily. And again, 2 questions were wrong, so that we'll be getting marks for that as well. But that's okay. Thanks for trying it out, right? Thanks for trying it out. So we have like again 2 months. We'll be having several mock exams once again. So actually speaking, there were like very little area where we could test on, right? A very little area where we could give questions, right? For this mock exam. So we'll see. We'll be having 2 another mock exams. So we'll see about it, right? So that's about it. So if you have anything you need to ask or you need to clarify, you can ask for me. Answer for question number 24. 24 is 24 is calculation of this price elasticity of supply. Is this? Yeah. It's like this. Right. So any questions from that? Nothing? It was easy, right? So it doesn't included any of the difficult questions. It was easy. It was like an eye opener for you to study. And that's about it. So we have some questions remaining in the financial system 2, TUT. We shall complete that as well. Right? Okay. What was the question we just have to start off with? Question number 1, 2. Question number 3 we didn't do, right? Did we do question number 3? No? Right. We shall start from question number 3 then. I'll check on that, Vidusha, and tell you. Right. Let's see another question being the same number. Yeah, I'll check on that. I'll check on all the whatever the concerns you have in that, right? And we'll give you whatever the feedback next week. This question number 3 we'll start off with. The following financial data refer to an economy for the period of 2011 to 2016. So you have been given the interest rates, bank base rates, and all the share prices, inflation, and everything. Using your knowledge of economic theory and material contained in the table, you have to do. Calculate with respect to the data given using the bank base rate, calculate the real rate of interest. And then secondly, calculate the real mortgage rate of interest. Thirdly, state whether real share prices rose or fell between 2012 and 13. Give a small try till I explain. You can refer back the tutor and understand the formula between real interest rate, nominal interest rate, and the money interest rate. Firstly, they are asking using the bank base rate. Bank base rate, calculate the real rate of interest for 2013. This bank base rate percent. Part 1. R is equal to 1 plus E divided by 1 plus E. So it's 5.5 and 2.3, the inflation rates. Yeah. Yeah. Oh, no. The system, right? So they are asking the equation you have to put is this, right? 1 plus m divided by 1 plus I. This is the equation we know, right? So they are asking for year 2013, right? So for 2013, bank base rate is 5.5%. Inflation rate you can get to know. Inflation rate is 2.3, right? So 1 plus R is equal to, I can write directly. I can write directly 1 plus, so that is 1.055. That is 5.5%. The other one is 2.3%. I can write it 1.023, right? So this is 1 plus R. This is 1 plus R. So how can you take R? Simplify this, minus 1, you will get 3.1%. For part 1, right? They are asking for 2013. It's just a matter of selecting the bank base rate and the inflation rate. Insert the figures here and take it. Secondly, they are asking calculate the real mortgage rate of interest for 2014. 2014 real mortgage rate. So it's 8.4 and then inflation is 3.5. So simple. Similarly, same on equation, right? Same on equation, real rate of interest. Real rate of interest, I can write 1.084 divided by 1.035 minus 1, right? You'll be getting 4.7% here. Those who took that 4.7, everyone? It's easy, right? So then you're asking state whether real share prices rose or fell in between 2012 and 2013. Real share prices. Yes. Okay, percentage increase 2012 and 2013. Real share prices. Right. Now see, in this question, guys, lot of information is being given, right? For 2011, 12, 13, 14, 15, 16, all the indexes and information given. So inflation rates also given. Firstly, we calculate the real rate considering the bank base rate, which is 5.5. Secondly, we calculated using mortgage rate, which is for 2014, it's 8.4. Thirdly, they are asking whether real share prices rose or fell. So, when you take 2012 and 13, when you take 2012 and 13, these are the share market indexes, right? From 2900 to 2919, it has increased, right? So, initially calculate the percentage change. Calculate the percentage change. How can you take? Percentage change. Percentage change. How can you take? Final minus initial divided by initial. How? 2919 minus 2900 divided by 2900. Calculate what's it? percentage change in share prices. Share prices. 2,919 minus 2,900 divided by 2,900 will give you, calculate and tell what? 0.66. 65. 66. 0.66%. Right? What's the inflation rate applicable during that period? Inflation rate is 2.3%, whereas the stock exchanges has changed by 0.66%. Right? So actually speaking, share prices has increased or decreased? Decreased. Although the share index seems an increase, in real terms, share prices has fallen. So you may show the calculation like this. Show the calculation 0.66 and write down this. First star mark, share price index represents change in the money value. Change in the money value. Share price index represents change in money value, which is 0.66%. Which is 0.66%. Inflation is 2.3%. Inflation is 2.3%. Share prices has grown. Share price has grown at a lower rate than inflation. At a lower rate than inflation in real terms. In real terms. So prices has fallen. So prices have fallen. Okay. Understood? Clear. You go to the next part of the question. Right. Quickly select whether these are true or false. 5 sentences. Quickly select. Rising real interest rates will encourage savings and investments. True or false? Those who say true? Those who say false? Right. Rising real interest rates will encourage savings and investments. Is it true? Only the real interest rate. Okay, next one. Interest rates will only affect business investment if that investment is financed by borrowing. That sentence. Interest rates will only affect business investments if that investment is financed by borrowing. That correct or not? Correct or not? Whether you borrow or not, you are subjected to inflation in the country, right? So for a fact, we can say it's incorrect. Rising interest rates in a country tend to raise the exchange rate for the country's currency. Correct or not? Those who say yes, those who say no. Rising interest rates in a country tend to raise the exchange rate. Exchange rate. What will happen to the exchange rate when the rate of interest rates increase? Not agreed. Right. Producers of consumer durable goods are more sensitive to changes in interest rates than in supermarkets. That sentence. Producers of consumer durable goods are more sensitive to changes in interest rate. Yes or no? Why? Central banks would not increase the money supply and raise interest rates at the same time. Is it? That is correct. So central bank monetary policy, what do? They either they need to improve the money supply or they need to remove the money supply from this. That is okay. So starting from one, rising real interest rates will encourage savings and investments. Build that. No? Those who say yes again? So you have this space here, no? We'll write. Put 1, 2, 3, 4, and 5. We'll write. What will happen? No, if not, I'll give you a print and pen. So these 5 sentences, it's important. I'll give you a PDF document explaining what is this. Right? It's not what you think. This is incorrect. First one. Second one is incorrect. Third one is correct. Fourth one is correct. Fifth one is correct. Those are the answers. I'll give you a document explaining. Right? Okay. Then we'll move to. Did we do question number 4? Do? No. Then 4, 5, 6, and 7. Where is that? This question did we do? Question number 4? No? Then quickly say. Which one of the following is not a function of a central bank? Easy. Which one of the following is not a function of a central bank? Management of the national debt, holder of the foreign exchange reserves, conduct of fiscal policy, lender of last resort. Which is answer? Answer? C. Fiscal policy means what? Taxes. Taxation part, it is not governed by central bank. Right? It's with the government. Okay, question number 4. Question number. Question number 5. We did this? No? Question number 5. Which of the following would be expected to lead the rise in share prices on the Hong Kong stock exchange? Consider stock exchange. Which of the following would be expected to lead to a rise in the share prices? Think. What's the answer? A fall in interest rates, a rise in the rate of inflation, a fall in share prices in other stock markets, expected fall in companies' profits, which is A. Fall in interest rates. How does that happen? When the interest rates fall, people spend more, and as a result, industry do start developing, and because of that, there will be really good influence on the share prices of the companies, right? Question number 6. A 30-year treasury bond that was issued last year may be sold in a which market? Treasury bond. Can it be money market? Can it be money market, guys? Can? Money market definitely not, right? Money market means short term. So this is a 30-year treasury bond. So capital market can be primary market. Definitely not. So secondary market. Capital market and the secondary market, 2 and 4 answer is D. Okay. Got it? Question number 7. If the central bank raise, see how they have written raise, it's incorrect, right? If the central bank raised interest rates, the most likely outcome on the stock market, same question. What will happen? So this was there's previously also, right? Central bank raised interest rates. Increase in interest rates. What's the answer? We suggested rise in share prices. Is it? Then? What's the answer we gave for the previous one? A fall in interest rates. No, in the previous question, they were asking which of the following would be expected to lead in the rise of share prices. Fall in interest rates, right? So this question is asking if the central bank raised interest rates, most likely outcome on the stock market. What's the answer here? Yes, the other way around, right? If the central bank raised the interest rates, most likely outcome, so what will happen? Increase in interest rates will increase the borrowing cost, right? So borrowing cost will increase, which will affect profits. As a result, fall in share prices. If you need, you can write down. Increase in interest rates will lead to borrowing cost being increased, and then which will affect profits. As a result, share price will go down. Next question. Yeah. Yeah. Can be. Can be. That can have different interpretations. So one perspective is that the companies have to incur huge borrowing costs. As a result, profits will drastically go down. So whatever the dividends they will be paying will be going down. So as a shareholder, I'll be thinking like I'll be getting less amount of dividends because the companies might be struggling. Apart from that, your reason is correct. So you might be thinking, why don't I pull out and I can like invest in the debt market? Or else I can go and purchase a fixed deposit. Why do I have to take additional risk and invest in shares? Can be accepted. Okay, next part. Question number 8. If a central bank pursues an expansionary open market policy, it will carry out which of the following? You remember I'm speaking about expansionary and contractionary monetary policy? Right? So expansionary monetary policy, what will they do? Expansionary monetary policy. What will they do, the central bank? Will they raise interest rates or will they lower interest rates. Low. Right? If a central bank pursues an expansionary open market operation, it will sell securities on the open market. Sell securities in the open market means cash flow happens how? Money flowing into the central bank or money flowing out of the central bank to the market? Money coming into the central. So that is not expansion. Buying securities from non-government holders. Then buying securities from non-governmental holders. Money supply coming into the market or coming into the central bank. What will happen? Imagine we have some investments, central bank giving money and taking our investments. Money flow happens to the market. Seems like the answer. So increase the reserve asset ratio, not reverse asset ratio, reserve asset ratio. Right? What will happen if you increase the reserve asset ratio? Lot of money will be coming into the central bank, right? So the banks can't lend much. Banks will have to keep more money in the central bank. Decrease the reserve asset ratio. What will happen? If you decrease the reserve asset ratio, now this is anyway incorrect. Reverse asset ratio, right? It's anyway incorrect. Decrease the reserve asset ratio. What will happen? Credit value will enhance. Here, expansionary open market operations policy, they are asking, now this is also increasing, tricky. This one also increases the money supply into the market. Isn't it? Isn't it? So previously, out of 100 rupees, only 2 rupees has to be kept at central bank. So decrease the reserve asset ratio means now only 1 rupee. So more money is coming into the market. True, but they are asking about open market operations. Answer is B. Okay. Understood? Clear? Next question. Question number 9. Which of the following is never an asset of a clearing bank? Which one of the following is never an asset of a clearing bank? Good, tricky question. What is the answer? A, B, or C, or D? Yes? Those who say C? Why is the reason? Yes. Whatever the customers deposits, when it comes to a clearing bank, in terms of the bank, what customers comes and deposit is a liability to me. Right? Asset and the liabilities work in the opposite manner when it comes to a bank's balance sheet. Clear? Understood? Answer is C. Question number 10, I think we don't want to do it. It's the same one which was in the mock, right? That was in the true sense a mock, right? They have really mocked at you. Isn't it? Don't worry, I'll give a mock exam again. Has given the answers as answer for the 7th question. What's the answer for the 7th question, guys? 7th question, answer is B. Tarini. Is answer for 2 is false. I can explain again why we chose the answer 2 for question 7. Question 7, why did we do anything wrong? Question 7. Yeah, answer is B. So when the central bank raises interest rate, central bank raised interest rates, most likely outcome would be a fall in share prices. I gave B, no? Right. So when they raise the interest rates, ultimately people will think of, so the one aspect is people, the companies will have to incur more money, will have to allocate more profits in terms of borrowing. So the company's profits will drastically come down. Because of that reason, confidence towards the shares from the shareholders will drop, and as a result, the share prices come down. Right? So share prices, whatever about the share prices, market confidence, anything like that will change the share price. So today I can wake up and say, this company is going to fail. See, if I say it like that, if people start believing me and things like that, share prices fall. Right? Market information going here and there. So because of that only, fall in share prices. What else? Yeah. Which question? 10th one, okay. No. In this question, it's not. It's simply, you just calculate the multiply and multiply, so you get 400 estimates. So if they ask additional amount of money created, right? Additional amount. Now, anyway, you from this 100, what you can ultimately create is 400. If that is the additional amount, 400 minus 100, that becomes 3. In this question, it's not. They have given the answer as 400. Okay. We shall have like good set of questions as a mock exam I'll prepare. Right? I'll give another set of 30 questions for you to do. We'll see. Because like the mock exam was like totally in vain. Okay. We'll see about that then. They will be getting 23, 24. Right. I'll give you a gift then. If you take more than 25. Right. Question number 11. ABC company has made a new issue of redeemable bonds. If the market rate of interest falls, how will the price of bonds react? If the market rate of interest falls, right? How will the price of bonds react? Think. Redeemable bonds, right? Bonds means debt market, you can tell. So bond market, that is debt, new issuance of redeemable bids. If the market rate of interest falls, what will happen to the price of bonds? Right? Put a star mark and write. If the market rate of interest falls, price of bonds will go up. Because they become a more attractive investment in relation to others. Because they become a more attractive investment to others. So what will happen? You have bonds, right? You have redeemable bonds. Market interest rates fall. So market interest rate falls mean for whatever the other investments, including fixed deposits and everything, you are getting very low interest rates, right? So when you get very low interest rates on fixed deposits and everything, what will happen? Everybody will try out doing investments in bonds. So demand for the bonds will increase. As a result, since these are redeemable, when you are trading these in the secondary market, what will happen? The demand increases. When the demand increases for these, don't say the supply, right? When the demand increases for bonds, right? Price for bonds will increase. Right? Price for bonds will increase. Okay. Right. Question number 12 and onwards we'll discuss the next day. Right? You just need to discuss. And mind it, guys, I'll give you another set of 30 questions for the mock exam. Right? Because the mock exam haven't fulfilled my expectation. Right? So as a result, I'll be giving another set of 30 questions as a mock exam. That is like from another 2 weeks after completing domestic economy even. Good set of questions, right? So we'll have that mock exam and see how the performance is. Right? Sorry about that, even I couldn't check what happened to the mock exam questions. I could have checked, but that's okay. So why there's a fall in share prices in the question 7th? As I said, Tarini, when you like question 7, right? Question 7 discussed about, yes. Wait. When you raise the central bank interest rates, the industries will have to incur a lot of costs when it comes to borrowing. So as a result, their profits will drastically come down. Because of that, that will give an indication to the market. And because of that, a fall in share price might happen. If anybody has questions, I'm here. Online participants, even if you have questions, you can ask. Okay.